Hello YouTubers, welcome back to the Independent Investor. Saturday, February 29th. Just thought I'd put out a video today, some comments on the trading of last week. Of course, last week was probably the worst week for the markets. Most major indexes falling about 12% or more. And that was the worst correction in the market since the financial collapse in 2009. I did say previous video, beginning of February, that I didn't feel the markets were really taking into account all the risks associated with the coronavirus and the unknowns. Especially on the supply side, and it seems that the market kind of woke up to that last week. So from going, I was roughly 30% cash at the beginning of the month, and I have been selling. I think I was about 40% cash, 50% at the beginning of this week. And then on Thursday, as the markets really continued to deteriorate, I went to about 97% cash, basically closing out my long positions. And while I was doing that, I actually shorted a couple, I think I mentioned last week, one or two that I had shorted, but I'll list the ones that I have gone short on. I've also done a lot of short calls for income, which I've talked about. I won't go through all the ones that I did, but I will leave a list on in the comments section. All these companies I think are overvalued, and if we get into a real bear market here, most of them will drop 50%, and some of them, and then the premium I received, and that which you get right away, and nearly all of these I think on the strike date will be worthless. So, but one of the reasons I started to go to cash too is the companies I had remaining were like pipeline stocks, a lot of REITs, which you know I like, but they started to be taken down with the market. For example, IPL, which I had, Inter Pipelines, it was trading around 22, came down to about 20. So I got out kind of before that, just because I've said in the past, I never really want to jeopardize my dividend stream or income by a capital loss. And what I mean by that, if you've got a dividend paying company, say it's paying 10%, it's trading at $10, you get a dividend of $1, but if the stock goes down $1.10, then you've actually lost on that because of the capital loss. So I think there'll be ample time with these companies to pick a point to re-enter. And I totally disagree with what many analysts are saying, that you should just kind of bear this out, and that eventually the stocks will come back, and then it's hard to pick the bottom. That is true, but with the technology you have today and the news, and there is quite a few indicators that have been proven over time that do show when the market has bottomed. I'll show one later, but there's probably a dozen of these, and don't rely on one, but if you rely on 6 or 7 or 8 of these, and they're showing the market is starting to bottom, then you can get back in. And markets always go down quicker than they come back. So once they start to bottom and come back, you have lots of time. The last major correction was 11 years ago in 2009, and quite literally you could have spent 3 or 4 years slowly putting your money back to work, and the people that cashed out towards the top are in a lot better financial position today, because the people that left their money in had to wait maybe 5, 6, 7 years just to break even again. And if you're young, that's okay, but for us boomers, we can't afford to wait another 10 years or so or 6 or 7 years to recoup our losses and start making gains again. So I've switched to the mentality now, especially we're towards the end of it. We knew we were towards the end of the bull market. I've mentioned about the shenanigans going on in the market, about share buybacks, all those type of things. The economy not really being as strong as it's portrayed. So all those things just put me in a mindset that it's better to sell early and then sit out and watch things kind of transpire, then slowly enter back in. And when I enter back in, I'll probably just buy, say I want a position of 1,000 shares in one company, most likely just buy 200 shares, wait a little bit longer, and then slowly rebuild that position. Personally, I think that's the best way to play the markets. Of course, everybody's been told different. You know, it's ETFs now, passive investing, and just add to your index funds. Don't worry. Most people don't even understand what the value of the markets are because they're just in an index fund, and that hasn't been tested either, especially with the boomers. When we're down 10%, they start to get out. When they're down 20%, they say that's enough, 30%, and if they all start to exit at once, then we could have a repeat of 2009. Plus the market just hates uncertainty. And to me, that's why I became cautious, because something like the coronavirus is not really like a slow economic recession, which we always come out of. It's unknown. We don't know if this is going to kind of peter out in the next month or two and the market comes back and everything's okay, but there isn't one person on the planet that can really say that right now. And most of the news coming out seems to say we're on the verge of a pandemic. World Health Organization now saying, extreme caution, and we've seen it spread to, Iran, Pakistan, Italy, United States, I think, had a fatality today. It seems that China does have it under control, but we still don't know how long we're going to keep all those people in quarantine. And there's a lot of migrant workers that went home over the Chinese New Year that now can't get back to their factories to work. And that we don't know how long they're going to keep the quarantine for. So that might be April, so now there's going to be factories that will be running either shut down or maybe at 50% capacity. And these factories are vital for the supply chain. There's been news in the United States now of shortage of drugs. Something like 80 or 90% of the basic chemical compounds that go into pharmaceuticals are manufactured in China, as companies like the big pharmaceutical companies have gone there to get their products at a cheaper rate. So we know the car industry, we've seen in Korea, I think Hyundai shut down a plant. So, and to build a car, if it takes 3,000 parts and you only have 2,999, you still can't finish the production of that car. And car parts are basically sourced from all around the world. And there was some other data coming out of China, just starting to come out now, which is quite shocking. That makes me think that this is going to go on a little bit longer. Basically, China manufacturing, the PMI index dropped to 35.7, and in February is at 50. So that's the Purchasing Manufacturing Index, so that's the purchasing of goods and supplies in manufacturing. Basically a number 50 is the dividing line between growth and recession, and that dropped to 35.7. It was almost as low as it was in the 2009 financial crisis. And we saw the same thing, but actually worse, in the non-manufacturing PMI that went from 54.1 down to 29.6, and that's in the service industry, like tourism, retail, all that type of thing. So people were talking earlier in the year of China's growth maybe slowing in one quarter from 6%, maybe dropping 0.4% to 5.6 or something like that. And those numbers now, with some hard economic data coming out, and starting to look ridiculous, especially when we know half the country is still basically in kind of a quarantine. And South Korea, which is like a mini Japan, is a huge manufacturing a center around the world, and we know the situation there is quite bad. So again, that's really why I went to, never done this in my life, gone to such an extreme with my cash position, but I think it's the right thing to do. And it's always a transition from a bull to a bear that's difficult. Once you know you're in a bear market, it's not that bad. You can do